let's welcome on board Nandan Chakraborty, the head of strategy at DAM Capital Advisors, to take us through what the market is shaping up to be like, what's the near-term outlook on the market, which sectors could be doing well, everything that's been happening with the rupee, bonds, so lots to chat about. And Mr. Chakraborty, get us started with your view on your near-term outlook on what the market is going to shape up to be like. We have seen to some certain extent, we've seen a slowdown coming in consumption and capex. Do you think these are going to be the themes that will turn around and lead the recovery in the markets?
See, the first, sort of imperative of any investor is to play the game that you're competent to play. So, I don't have any near-term view because we are into an investing, profession, which is for institutions. Otherwise, we get manic depressive, and traders can afford to be manic depressive, where news which is good for Main Street may not be good for Wall Street, and vice versa. That means if inflation is high, then Fed rate cut will come, and therefore markets will go up, even though the outlook is bad. These sort of games is very difficult for us to play. So I can give you a sort of 1 to 3 year outlook and the factors which affect it. I cannot give you any near-term outlook because that's not the profession that I'm in. Having said that, see, there are about 6 or 7 known unknowns at this point in time. One is how Trump affects the global currencies, because there's likely to be a lot of currency devaluation, competitive devaluation across the world in case he brings in tariffs. Also, there's going to be a lot of uncertainty in when he will be able to do what. Also, the sectors which affect us in terms of Trump, which is metals, IT, energy, and pharma, the factors which drive these 4 sectors are far more important than what Trump does or doesn't do. So that's one big uncertainty. Next uncertainty is consumption and capex, which I'll come to, which is what you asked. Third is wars. Sorry. So again, wars, we don't know, what's going to happen in terms of the logistical bottlenecks of both exports as well as imports into India and so on. And the last is rates. So rates, the new governor, RBI governor, has a quadrilemma at hand. One is what he does in terms of, whether the Fed, as the Fed rate starts cutting, what does he do? Because he has to sort of, forecast what the Fed will do, or do what the or act after what the Fed will do, because typically it takes about 9 months to a year for interest rates to flow into inflation and growth. So that's one. Number 2, his own play on inflation versus growth, and the third is what Trump manages to disrupt in terms of the currency wars across the world. Coming now to consumption and capex, I think we'll get some clarity on this only over the next 3-4 months, roughly from the next financial year, first quarter. I don't think you'll get any great clarity in the next 3 months. The reason I say it is because consumption is being largely affected in the short term because of the erratic monsoons last year, which led to a lot of inflation and therefore consumption issues. So it led to income coming down in the rural area as well as inflation. And that, once the Rabi harvest, the winter crop harvest, comes in during March, April, I think we will see that bouncing back. As far as capex is concerned, the government has rightly, eased the regulations for state spend. It had an issue in terms of spend before the elections. So again, I think it's only over the next financial year that we'll see a state capex and then the private capex take off.
Mr. Nandan, hi, good afternoon. This is Ankita also joining in. A couple of things that are playing out right now as far as the global markets are concerned. The elevated levels of dollar, which is sitting at its 2-year high. The bond yields have ticked up. And of course, with the Trump policies, it is likely to strengthen the dollar index. And also, that makes it more attractive, especially the elevated bond yields. It makes very attractive for foreign investors. And of course, we are seeing continuous FII outflows from the Indian markets. So does that really give us the opportunity to now buy into large cap names? And if yes, then what are your favored, where are you seeing value, pockets of value, or the sectors that you are bullish on in that case? Because I can see your top bets. You are betting big for the next 12 months. You have RIL, HDFC Bank, some big names there. What are the pockets that you're seeing value in now?
You asked me too many questions at the same time, so I'll have to cut them. I have two lists for the stocks that I'm recommending. First, I'm saying that this is going to be a very uncertain market. Therefore, I have a list of doublers. What I mean by that, as I've got a list of stocks. Sorry, bad day. I've got a list of stocks where my earnings growth is going to be high enough for it to double in the next 3 years. So that's one list, and it's largely a mid cap and small cap list with one or two large caps in it. I have a second list which says that for a 1 year perspective, these are my large cap list, because since my doublers, which are more or less sort of guaranteed returns, since that may take some time to play out, and one needs a portfolio allocation stance for large institutional investors. Therefore, I also have a large cap list. So that's one thing. Second thing, you talked about dollar and so on. Now, the way the dollar affects me as an Indian is basically we are a twin deficit country like the US, but we don't have reserve currency advantage. Therefore, the way it affects me is my twin deficit gets adversely affected whenever the dollar rises, and vice versa, and leading to a vicious cycle or a virtuous cycle. So the dollar affects the twin deficit, which in effect again affects the dollar, and so on. So which is why I'm very vulnerable to the currency. This is a macroeconomic factor that very little to do with whether I should invest in IT or pharma because they're exporters, or something else because they're importers. Because the drivers for that is a completely different dynamic, and I have far greater drivers for those compared to what happens to the dollar. Yeah.
Okay, Mr. Chakraborty, I'm also seeing from your report that you are overweight on financial services, with of course a bias to large caps. But if you have to play this entire basket of stocks, would it be private banks, PSU banks, or would you rather pick NBFCs as your preferred play when it comes to financials?
I'm in the happy position of recommending all three within BFSI. And the reason for that is, see, on the one hand, your consumption and capex recovery both are likely to happen over the next 3 months onwards, because both have been very weak in the last 1 year. Now, if I have both drivers, the operating leverage to consumption and capex is the highest for the banking sector. And banking, I'm including the entire BFSI, which you've talked about. So that's one. That is basically the growth driver. Number two, the valuations are, what they are. They're quite low among most sectors. They're below the average for the last few years. Number three is the minute it starts, consumption and capex start off when the monsoons become okay, then my regulatory easing starts, which has been a big hurdle. So I have too many positives. I have a re-rating possibility and I have an earnings growth possibility in all three segments, which is private banks, public banks, and NBFCs.
Mr. Nandan, talk to us about the broader markets. Now, when an economic slowdown happens, like there is a slowdown in our economy, the mid cap and the small caps are the worst hit for that. But given the FII outflows, it is obviously happening in the large caps. Do you see an outperformance coming in from the broader markets this year, or the large caps will take center stage? And what are your bets as far as the broader markets are concerned?
So again, there are two different types of plays altogether. So I have an entire section in my strategy reports why I have said that basically the PEG, that means the growth to price earnings ratio, that is more favorable to small caps at this point in time. So I have an entire section on that. I can't, it's not possible to go through all of it. But in substance, see, what has happened is during COVID and all that, the small caps basically crashed. So you had economic slowdown, and therefore, as you said, you had your margins as well as sales. That means the fundamentals of small caps falling. And at the same time, the valuations were also high at that point in time. So you had a double benefit of a PED re-rating as well as an earnings growth recovery. So that was the second stage, and which is why, every, sort of driver and maid and everybody in India, security guards, everybody started putting money in small caps in India. And fund managers, poor fellows didn't have any choice but to put more of their allocations into small caps. Then came the second phase, which was last year, which was the small cap growth was lower and the valuation was higher, much higher than the usual one. Now we are going to come to a stage where the earnings growth will be high and the price, that is the premium, has come down. So you have the PEG, that is the price to earnings growth ratio of small caps at 1, whereas that of large caps is 1.5. So this is in terms of, let us say, a 3-year strategy. I think one should be in good small caps, okay? Not the weirdo ones which, went to 100, 200 PE, obviously, this thing. On the other hand, the large cap ones are the ones which give you stability, because, you can't, no investor can face up and downs, which happens in small caps on a sustained basis. So you have to have your ratio from large caps to small caps. So these are two completely different strategies for any well-rounded investor. They don't compete with each other.
Okay, Mr. Chakraborty, on that note, we'll let you go. Thank you so much for joining us, sharing your views on the market as well as sectoral outlook and where we are headed from here. Thanks once again for joining us and speaking to us at ET Now.